Topics for this month. We're going to start off with the market trends and the sector view. In the sector view, we're going to go a little bit deeper to understand who are the winners and who are the laggers. That is one thing I do it in every video. If you check my previous videos, you'll probably know how the trends are. I look at a little bit deeper into the sector rotation. That is a key thing for any investors to see where the funds are flowing. And then I look at a little bit deeper into the Spider ETF. Spider ETF is a kind of diversified ETF we have. And I generally look at the trends of that ETF to understand how the investors are playing in this market. It's kind of in a defensive mode right now for this month. We'll go a little bit deeper into that. The next thing which I wanted to discuss is the dividend performance. I'm a pure dividend strategy investor. I take my year from July to July to look at every month's dividend amount which I get. I can aggregate them and I share that end of the year. Last year, I took a target for this year between 2025 to 2026. I'll show whether I met the target or not. That's another topic I wanted to share here, how my dividend strategy is performing and what's going to be my new target for 2026 to 2027. That's the second topic which I wanted to discuss, followed by the dividend stocks. I generally pick up few stocks to share for my viewers. If you've seen my previous video, I'm following the same trend here. I picked up few stocks to showcase for this video, for this month's video. So that those are the three topics I have for this view. So stick around for more details. Sector rotation is a key thing for any analyst to look at a little bit deeper where the market is trending. When I look at the sector rotation, past 1 month, the leaders have completely changed. The new set of leaders showed up, starting with healthcare, energy, and financials. These are the top 3 sectors happening right now. Most of the investors are actually moving funds into these sectors. This is more of a defensive sector. Looking at what's been happening past few months, the information technology sector has been badly hit. Some of the semiconductor companies, people have reached to the max point. I think they are currently taking out the profits from these semiconductor companies and moving that into a more defensive sectors right now. Why this trend? There are a lot of things contributes to this trend. One is people want to see a very stable growth in the IT sector, which is not what they are seeing right now. That tends to put them in a more cautious mode of moving the funds out from some of these semis and into some of the stable companies or more defensive sectors like healthcare and energy. That is one reason. Additionally, with the Middle East geopolitical stuff which is happening, that contributed to some of the changes in the energy sector, some boom in the energy sector, followed by the financials. So financial is more of a safe zone for parking some of the funds. That way, you still get a very stable growth of your funds. So these are our top sectors for this month. Looking at a little bit deeper, the top leaders under healthcare are Eli Lilly, Johnson & Johnson, United Health. These are some of the top sectors, top companies in this ETF. But looking at the growth standpoint, there are new companies here. Viva is one. This has been performing consistently well. I've seen their reported numbers. They are always beating the expectations the quarter over quarter. So that gives a steady growth to this company. Very solid, fundamentally sound company it is. And there are some other newcomers in the top performers in this sector. But the major ones are Eli Lilly, United Health, Johnson & Johnson. These are some of the top weightage in this particular sector. Followed by the energy sector. You have the same old leaders, basically looking at ExxonMobil, Chevron. Some of the oil prices have gone up. Plus, it's a summer, so there's obviously some level of demand is there for energy sector. People are traveling, they are using their cars, so the gas prices are adding up to this growth. Additionally, there are some other companies, Marathon, Petroleum Corp, Valero. So these are some of the notable top performers in this sector ETF. When you jump into the financial part, Berkshire Hathaway is one of the leader here in this ETF, followed by JP Morgan, Goldman Sachs, Bank of America. These are top companies in this XLF, the ETF. When you look a little bit deeper into it, PayPal played a big role past few weeks. All the positive news coming out, the Stripe trying to acquire PayPal for $60 something. So that actually kind of added up to this performance here. And there are a few not notable ones, but they have been performing very well, other companies. But the top leaders are Berkshire Hathaway, JP Morgan, Goldman Sachs, and Bank of America are the top weightage company in this sector. So looking at the sector, these are the top 3 sectors. Information technology, people are moving money out from this sector into other defensive sectors right now. They want to see how the AI is performing, which is what they are not seeing a growth there. people are a little bit cautious that it could be an AI bubble here, which we don't know. There is no proven data to say that there's a bubble here, but investors want to know how these AI companies are going to perform, what are their returns, and then based on that, they'll probably jump back into the sector. And on top of it, semis, I think they have hit the max limit, top bar ceiling. I think they're investors are pulling the money out from some of the semis and moving it into some defensive sector here. That's kind of the overall summary I see from the sector standpoint for this month. For quarter 3 months, even IT is still at the top level, which is the 13%, but past 1 month, the leadership has changed. So gradually, the healthcare should take over the IT sector. We have to wait and watch and see how July, August is going to span out. Maybe we might find some new leaders coming up for this quarter too. So that's kind of the overall sector rotation here. Next thing to look at is the Spider ETF. Spider ETF is another indicator for evaluating the market movement right now, or in general trend. Looking at the Spider movement right now, it is in a sideways turn, which means the investors are slightly cautious here. They are taking a defensive approach here. They don't know how the AI thing is going to turn out to be, how these companies are going to perform. Earning reports are here, so they're taking this cautious route that, hey, let's wait and see how the earnings are coming out from the IT sector and then invest back. And the additional thing is that they've already hit the max limit in some of these semis. So it has hit the peak. Semis have hit the peak. Memory companies have hit the peak. People are trying to pull the profit out from those semis and memory stocks. That's what you're seeing right now in the market. These investors are pulling money out from these high performing companies, semis and memory, and they have moved that funds into some of the defensive sectors like healthcare, energy, and financials, where you have a more steady, stable growth. It's kind of a fallback sectors for some of our investors. If they feel they want to be defensive, they move the funds into it. And at the same time, I also see volume is picking up in all the mega 7 companies, where you will get a steady growth. AI impact will be there in some of these mega 7, but their core products are performing well. AI is kind of a smaller contribution to their profit, but it's still not there yet. They have not shown significant growth in the AI enablement, but you might see in the upcoming earnings whether they have taken advantage of this AI boom, or they're kind of laggards there. So we have to wait and watch in the IT sector. To wait and watch, that's where investors are moving their funds into some defensive sectors like healthcare, energy, and financial. Energy, there's a geopolitical stuff is happening. So by looking into the Spider ETF, it is in the sideways movement right now. You could see the higher lows very evident, and that the trend should continue in the same direction. So for an investor, when you see kind of a defensive model in the Spider ETF, which means investors are not sure what the future is going to be, what the earnings are going to be, so they take that kind of defensive mode. So it is going to be churning for a few weeks. There is a support level, which is 726, 725. Resistance is at 754, 755. Anything beyond that, when it crosses the resistance, that's a point where you can invest back. Or when you look at when you buy, like if you want to buy something, don't buy bulk. Instead, you take a smaller batch of whenever there's a pullback, just buy it in a smaller batch, accumulate it, because the Spider ETF will come back when you see a strong growth in their leaders. And a Spider ETF has a wide variety, diversified funds allocation. So any one particular leader should help the Spider ETF to come back to its leadership role there right now. So for now, it's more of a cautious route. Looking at the volume is also not that much. It is hitting somewhere around 62 to 60 million in an average, 45 to 50 million in an average, which is what I'm seeing. There kind of few are pullbacks, which we have seen, distributions, more heavy distributions on few weeks, and then slow accumulation on a few weeks. So I look at kind of buy points when there is kind of crossing. You look at the RSI. When the RSI crosses the moving average RSI, then that's a point I generally put some money. Kind of slow allocations. Buy in a smaller batch. Don't just jump in and put entire funds into that. Rather, just buy in a smaller batch and just start accumulating it. That's the mechanism every investor has to do if you want to stay in the game, rather than ignoring it or to getting too excited and investing more right away when the market is not showing you that kind of signal, kind of a growth signal right now. So currently, the signal is all very cautious signal right now. So that's what the trend is right now. So you will see some downward movement in the Spider ETF. My buy point would be anything beyond 760 is a good buy point that confirms that the trend has changed, and now the SPY ETF is picking up with the new leaders, or it could be the same leaders. So we have to wait and see. So from the volume standpoint is good. The demand is kind of in a sideways movement, so it will continue for weeks as the price movement continues. It's going to match that demand. Then once it hits the kind of the average 35 mark, and when it picks it up, then that's a good point to invest back into this spider ETF. So that's what I'm seeing right now. This is one ETF I closely monitor to see how the market trend is. We've been predicting this one since March. It has gone up 21% growth, which is a significant growth. So as an investors, you can actually take the profit here because it's currently in the sideways moment and wait for the pullback. That's what I see right now in the market. Let's start with the dividend performance. Dividend performance is no gimmicks. First thing I want to call out, it's just dividends. I'm not including any capital gains which I received from whatever I've deployed in my account. That is one thing which I wanted to clarify. Plus, dividends are true. There is no gimmicks around it. There is no news which could spike the dividends higher. This is consistent dividend-based strategy. And this year, I was able to hit my target. This is up 28%. My portfolio was up 28% year over year. Previously, the last year target was slightly lower. This year, I took additional target. I was able to hit that 28 to 29% year over year. And then followed by, when I do this dividend strategy, I look closer into the stocks to look at who's performing, who's paying you better dividend, and whether you're able to hit that your target or not. That's a key thing. So finding the losers, cutting them off a bit early, and keeping the earners is a key thing. It's basically calling it as a rebalancing. Rebalancing, that way you can stay longer in the game and making sure that you're going to hit the target. Whatever target you have taken last year, I've taken a target for last year for my dividend strategy model. Did I hit the target? Right? If I have to hit the target, what do I need to do? What rebalancing I need to do? So those are some of the exercises I went through the whole year to readjust, to restructure my portfolio, dividend strategy portfolio based on the outcome. So rebalancing is key. The total investment I have, cost basis, is 171K, which is fully deployed. Nothing is on the sideline. Everything is deployed in the dividend giving stocks, and whatever dividend I earned month over month, I aggregated them. And then at the end of the year, that's what I'm sharing right now. That's what I look at it a little bit deeper, saying, okay, did I hit the target or not? I was able to hit the target. Close to 29% is what I could hit this year. So 171K is completely deployed, nothing on the sidelines. And the target which I took last year was 45K. I was able to hit the target. That's a key thing. So dividend strategy is a true strategy. If you stick to it, being true to it, it will pay you a good dividend, a good return. So there's so much excitement going around right now. The AI, and then the chip maker, memory. There's so many things happening around you. Staying focused to this dividend strategy is a tough decision. And if you are decided to take this dividend strategy model, you have to stick to it. Even though there's so much excitement you're losing, it's okay as far as you're able to earn the income. So I was able to hit that 45K target. And next year, the target is actually, I'm bumping up the target. So if I have to bring some additional cash to get to my next stop, which is 50K is my target, just pure dividends, nothing else. The investment which I did, 171K, it actually paid off a 45K, higher than 45K dividend this year. And next year, I'm taking 50K as the target. I'm going to just stay focused in the dividend strategy to see whether I can hit that 50K target. So let's just jump into the numbers. Looking at the numbers, this is what I have from July 2025 to 2026. That's what the whole year's numbers are. Looking at it, I aggregate them every month over month. And then if you aggregate them, sum it up, I did hit 56K as dividend only. What I did is I removed some additional dividends which I received from other companies which are not part of this 171K. So that way, the numbers which I'm showing, it's true to what I'm sharing here. 171K is what deployed. And then whatever additional dividends which I received outside this 171K, I removed it. Part of my profit and loss. I call it as a loss, but basically they are an additional dividend which I don't want to share. I don't want to bump up this number. So that's what removed on those respective months. Ended up my target, more than my target. I took 45K as the target. I ended up with 48K. So dividend strategy is true if you stick to it and be disciplined rather than getting deviated from all the news, all the noise happening around you, the AI, semis, memory, energy, geopolitical issues. Sticking to just basic dividend strategy stocks, finding the good fundamental stocks, and identifying the companies who are paying dividend and gradually bumping up the dividends, it pays you. End of the year, it pays you. The accumulations are smaller if you look at it. Sometimes the day trading or swing trading, you might get a higher profit, but year end everything gets balanced out. But dividend is a true strategy. It's a compounding strategy. If you do it sincerely and slowly accumulate the month over month earnings, dividend earnings you have, when you roll it up end of the year, you will be surprised to see how much you gain. So dividend strategy is a true strategy. Um, I like to stick around with the strategy for longer. I'm not changing my strategy anymore. I'm going to stick to the strategy, and I'm bumping up my targets for next year. So let's see whether I can hit the target next year target. If I have to bring some additional money, I'm going to bring in, and I'll try to hit that target. So that's kind of the thing which I wanted to share in this video. Thank you. What does the extra dividend will do for you? You can pay off your home mortgage, just be a debt free after that. You know, you're looking at yearly dividend just paying off you reduce your mortgage payments, or you reduce your total debt which you incurred by buying a house. You can pay off college fee, or you can pay yearly college fees for your kids, or you can save it part of your 529 plan, which is again a college funds, which where you can save this money. You can invest back into the stock market, finding another good dividend paying stocks and investing back into that. That's another strategy. We will go a little bit deeper. If you don't have immediate need for using this dividend money, you can redirect or invest into some other dividend paying companies where you can multiply it. You can compound the dividend amount or returns. That is one key strategy which I'm going to dig deeper into it in my future videos. Or you can look at your bucket list, and if you're end of your career, retired, or you're looking for passive income, some of this income you're getting it here as dividend, you can use it to finish off your bucket list. Either you're traveling or some interesting bucket list items you have, you can go get that thing taken care. So there's endless possibilities here with the dividend income. You can argue that, hey, can I get the same kind of um, a solid income from some of the short-term investments or swing trading, day trading, and other stuff? These strategies are there if you're well versed in the market setup with a good knowledge. If you can earn that money through this short-term investment strategies like day trading, swing tradings, very well, just go ahead and use it. I'm not that familiar with some of these short-term strategy. I've played as a swing trader, day traders, but I couldn't consistently get the income what I was looking for. And when I switched to dividend strategy, that actually helped me to build that patience and then compound the dividend amount month over month. And end of the year, when I look at how much I earn, you will be surprised to see, this is a significant income which will help you to do a life-changing moment here. Just paying off a debt is, or paying off for college is a big thing for some of the middle class families. And this dividend strategy will help you to get there rather than gambling in the market. So this is one possibility. There are a million possibilities are there. As an investor, you can look at some of this dividend earned income. You can actually use it in the right place and get that financial independence. That's kind of the message which I wanted to share here. Stock for the month is about Dynex. It's actually a mortgaged backed security company, primarily in the real estate business. I know the real estate is not so doing well in this particular time period. Past few years, it's been down. Primary reason is that it does have impact due to high interest rates. That's one key thing where most of the real estate companies or mortgage-based companies are struggling to get some earnings going. And in addition to that, so much volatility is there in terms of the local tariffs and other things where the material cost has gone up. That also had an impact in the real estate business. So it's not just one reason. A combination of reasons actually had an impact on the real estate. But things are slowly recovering. I believe the second half of this period we will see not a significant growth, but at least it won't go below this. It has actually hit the rock bottom. There's nothing else to go beyond this one. I think there is no more bottom we can see here unless the current government comes back and increases the interest rates, which I believe is what the Fed chairman is trying to do right now. He's just looking at the data and he's going to make some decision end of the year. I believe it seems like there will be an increase in the interest rate. I don't know how much it's going to be, but there will be increase. What will be the impact on some of these mortgage and real estate based companies? You will see a little bit of a gap up downwards, pullback. Right now, I picked up a stock called as Dynex Capital. This is actually a mortgage based security. It's been there since 1987. Uh, the reason which I picked it up was this actually has a very attractive dividend of 15.55, close to 16%. They recently increased the dividend, which is very strange. Kind of, in this kind of environment, in this kind of market where most of the real estate and the stock market is actually struggling in this time period, we don't know why they bumped up their dividends here, which again, it's kind of an attracting strategy. Sometimes these companies will try to do that. But from the technical standpoint, so they've been in a base since 2023. There was quite a bit of churn within this box period between $17 to $12, $11 is what their box kind of support and resistance level. They've been churning within this period, within this price range for quite some time. But the trend of late since 2024, it's kind of upward direction. You can see the higher lows are kind of up, which means it's actually the trend is in the right direction. So which is a good sign. I have seen this particular stock in some of the leaderboard. IBD is one which I follow. They have this particular stock in their listing. I'm not sure whether it's in the top 100, top 500, top 50. I'm not sure, but I found this particular stock and I did some research around that. And this will be my next thing to go see. So you get a pretty good dividend here. The demand is pretty low to moderate, but the trend seems to be in the right direction. So the fundamentals may be a little bit lower side of the thing, but in terms of the price trend, the price is actually moving to the right direction, and it has institutional presence also there. So some of the institutes like BlackRock and other interesting companies, institutional companies, have some investment in it. We see the Vanguard Capital Management also has an investment in this one. State Street Corp is also there. Millennium Management, Victor Capital, the couple of institutional buys are also there. They have accumulated some good, significant, shares in this company. I believe it's primarily because of the dividend side. So, from the fundamental standpoint, it is kind of struggling. But looking at the institutional as well as the dividend increase in the recent months, which makes this particular stock attractive. That's what the trend is. So, looking at the moving average standpoint, they're not perfectly aligned. I think if you look at it, the 50 days is higher than 20 days. 20 days is higher than the 9 days or 10 days. So usually I tend to buy when the entire thing is in the reverse direction, like moving average 9 is greater than 20 days moving average, and 20 days moving average is greater than 50 days. That's a perfect alignment for me to buy. For now, I'm going to watch this stock progress, maybe slowly accumulate when I see some positive momentum going. It's a slow growth, which is expected when you see a dividend like this. So it's going to be a very slow growth. It's attractive. People will put in, but it's going to be very tight growth. You won't see a gap up or gap down. So it's kind of steady growth there. Demand standpoint, moderate demand. I think it's not there in that standpoint. So plus the volume off late, the volume actually picked it up. Good chance that some of the dividend increase attracted the customers or investors right now, because there's no other place to earn income right now. Most of the stocks are struggling. Semis are struggling. IT is struggling. Some of the big time companies are struggling right now in the market. It's very volatile. People tend to take some safer place, especially when you look at a dividend like this. People tend to take that safe place, saying, okay, it doesn't matter what happens in the market. Let's just put the money here to get that 15% dividend. So that's the intent right now. That's kind of the view I'm getting here. You can see that the volume has actually spiked up to an average of 20 million shares getting traded per day, which is significantly higher compared to the last year and a half, 2 years since 2022 from pandemic onwards. So there's some level of volume increases there, which is kind of attracting. That's how I ended up in this stock. I look at the volume spike. I ended up in this stock because of that reason. And the another attractive thing is that the dividend is actually a monthly based dividend, which is very good for passive income seekers. If you're looking for monthly an income to come in, this is another stock to go invest in, which makes your account active. You could see that funds flowing in, and you can distribute to other stocks, or you can retain it, multiply, compound it here itself. You can either kind of take the dividend and put it into other stocks. When you see the other stocks cheaper, you can actually move some of these dividend money into that, or you can retain it here, let it multiply, and the dividends is going to flow in. So that's the overall direction of this chart, the trend standpoint. I won't call it as a good buy, but when you look at the dividend, it seems very attractive. Would it have an impact, negative impact in this company? Not immediately, but the moment when we talk about interest rates increase, then there is a good chance there could be a pullback happening if the interest rates goes up, or sometimes or it could just steady up or churn in the sideways rather than going up or down, because there are big time institutional investors out there. They don't generally like to pull down some of these stocks where you get a pretty good dividend. So that's kind of the overall sentiment or kind of view of this company. Let's move on to the next one. The next stock we want to talk about is Amplify Enhanced Dividend Income ETF. The ticker symbol is DI, D for David, I, V for Victor, O. This particular stock is a combination of long-term capital growth option, and it has a covered call concepts too. Generally, when you look at covered call high income ETFs, generally they give you very attractive dividends. People tend to invest money into that those types of stocks because they pay you very good dividend. But the downside is that there is less appreciation in the capital, and if you don't manage the funds properly, or premiums properly, the returns could also suffer. There is a risk factor too. Sometimes they tend to give you more in the dividend. At the same time, the capital appreciation will be going down, which means that whatever they're paying you, they're compensating, they're getting the money back through the capital by declining capital appreciation. So that is a very common strategy in the covered call, or common, what do you say, an item in the covered call dividend ETFs. But this one is slightly different model. The fund manager for this one choose a different strategy here. So, if you want both a high income through a covered call concepts, plus you want to have a capital appreciation. If you want both the factors in, then this is the ETF to look for. This ETF has a philosophy or kind of a model where it increases the capital gain. At the same time, half of its funds is put into the covered call concept. So you are actually taking advantage of both the strategies here. So that's the best part in this fund. It's an ETF. Primarily, the income is generated based on the dividends which we receive from the big time companies where they invest in, and some option premiums too. So that's kind of the strategy for this one. And the growth, you could probably see it is since 2023, it has grown 35% year over year, around 29%. 20 to 29% is the growth. Past 5 years, we are seeing it. It's a good growth. At the same time, the investments or the current holdings are also very significant holdings. If you look at the funds, 100% is invested in North America. And if you look at it, big time companies, these are big time companies, Apple, Caterpillar, and Microsoft, JP Morgan. So these are big time investments, good fund allocations here, which means that your capital appreciation is good. It's if these companies are going, these are foundation for the stock market here in US. And if these companies are going to grow, they're going to grow slowly, but growth will be there, and they are the backbone to this economy too. So these companies are going, if they do well, this particular stock is also going to do well. So if you look at past 2 decades, I think these companies have actually been the big game changer in the economy, so as well as in the stock market. So they have invested in the right place. The ETF has put funds in the right place where you have the capital growth. On top of it, whatever dividends which they get from these companies, they're distributing that dividend back to the investors. Plus, in addition to this, to have that high income strategy or high income returns, they're actually also trying out the covered call concepts. So there are ETFs, they do that covered call concepts where they're using the option premium. They receive the option premium and they distribute that option premium as an income, monthly income, to some of the investors, or in general, whoever invests in that particular stocks. So that's two types of strategies combined together is what this particular ETF is. So from the investment standpoint, holding standpoint, they've heavily invested in the North America region, 100%, plus covered call concepts pays you an additional dividend for the investors. And the other attractive part is that their dividend is between anywhere from 4 to 8% is the dividend. It ranges from 4 to 8%. Plus the capital appreciation is also happening behind the scenes. So it's trending in the right direction. Plus the dividend is a monthly dividend, which is very attractive for passive income seekers too. So this is one attractive stock which I've been looking into. Now, why it showed up in my research, in my watch list, is basically the volume. The volume is a big key here. Since Jan, the average volume has gone up to close to $1.5 million. So that's kind of the trend which I'm seeing. That's why this stock has been consistently showed up in my research. But I didn't talk about this particular stock because I didn't really understand behind the scenes what they've been doing. Their capital appreciation is good. Sometimes when you have a good dividend, attractive dividend, and a capital appreciation, so those two combination create some kind of skepticism in the market. So in the investors community. So that's a key thing which I generally tend to stay away. But when I researched this particular company recently, there's a lot of positive things about this particular ETF. The ETF is trending in a good direction. We got some good fund managers there. So fundamentally, it's a sound ETF with a good dividend and capital appreciation strategy. So that's why I'm bringing it to the viewers here. Looking at some of the trend off late, I think since 2023 onwards, we have a very good trend, close to 35% growth year over year, around 20 to 25% good returns, capital appreciation. On top of it, they are paying you close to 5% dividend. Between 4 to 8 is what the range consistently they've been paying. So that's a good thing with a nominal expense ratio there. So it's a monthly dividend. So from the trend standpoint, it is in a good trend. It's been in a base for a very long time. Since 2022 till 2023, it broke out of the base. And then the trend actually was significant, which was around 35% growth. So we should see the trend continuing here. Basically, it should see a sideways turn because of the market conditions. Some of the big time leaders in the holdings, like Microsoft, JP Morgan, and all those people, are kind of taking a cautious route or kind of direction right now because of the market. You should see a steady, a very tight growth in this particular stock. So that's kind of the trend which I'm seeing. You should see the price increase gradually. The good buy point is that you can invest right away in a smaller batch, plus you get a 5% dividend on top of it, which is a good thing. And the growth is in the positive direction. And there are three things which I look at it. First one is the moving average. Moving average is perfectly aligned. You can see the 50 days is lesser than 20 days, 20 days is lesser than 10 days. So the moving average is perfectly aligned. This is a right place to invest in. Volume has grown significantly half late past 1 year. People have invested in it just for the dividend sake. Plus, they trust this particular ETF because their holdings are heavily on North America companies. And these companies are big time companies in the market. So they've invested in the right place. They have good strategy. Their trend is good. The strategy of a capital gain is a very attractive capital gain strategy. Plus, they're paying you monthly dividends. So all positive about this particular ETF. From the demand standpoint, demand is kind of on and off. I would say just ETFs generally has the same mechanism. They are very tightly moving in the positive direction. Demand will be very nominal based on what we see here. Looking at it, it is kind of in a moderate state, but it is good to be in the moderate state because you don't want to see surprises, volatility, too much volatility here. Keep that the steady growth going with a good dividend of 5% puts this particular ETF in the right place to invest. So this is a good stock to invest in. So from the trend standpoint, it's in the right direction. So you will see a little bit of sideways churn as the earnings go through, and some of these big leaders where this ETF has invested in, once they start performing, you should see the growth continuing. So all are positive about this particular stock ETF. So good dividend paying ETF for us to invest in. So that's kind of wraps up the second stock which I wanted to discuss here. Thanks for watching our video. If you enjoyed this video, be sure to like, subscribe, and hit the notification bell. Until next time, happy investing.